Welcome to the Tactical Edge, a show that sorts through all of the noise and commotion out there in an unrelenting pursuit of the signal. Thanks for joining us.
Raj Bhuyan is a managing partner of Tactical Wealth Management. Advisory services are offered through New Edge Advisors, LLC, a registered investment advisor. Opinions expressed and information shared are for informational and educational purposes only and should not be considered as a solicitation for the purchase or sale of any security. Please consult a tax or legal professional for any specific information related to those topics. Past performance may not be indicative of future returns. Investing involves risk and the possible loss of principal capital. For those seeking additional information, please visit our website at tacticalwm.com and contact us.
Hello, welcome to the TWM Tactical Edge podcast. My name is Raj Bhuyan. I'm a managing partner at Tactical Wealth Management and really excited to be able to use this medium to share our team's philosophy and the process by which we manage investable assets for our clients. Before I get started, we have to go over a couple of notes. Number one, this podcast is available on audio format. And if you would like to see the illustrations and charts in this presentation, please go to our website at tacticalwm.com and click on the Insights button. And number two, data that are shared and opinions provided are not to be construed as specific investment advice. If you want specific investment advice, please reach out to us, but please use this presentation as informational in nature. Okay, let's get into it. So this is an illustration of our current working hypothesis at the macro level. And that is, on a relative basis, this is what the financial markets have essentially looked like for the better part of the past 2 decades. One could have been on an investment platform resembling that of a cruise ship and would have done quite well. The S&P 500 being the arbiter of this period, you can see that on any major dip, if one were to buy, they would have been rewarded handsomely. And in this nearly 17-year period since the March 2009 lows, the S&P is annualized at nearly 15% a year, every year, over the past 16 and a half, almost 17 years. Now, what if the prospective environment looks a little more like this, where a cruise ship really may not have much of a chance? And this is a period, if I were to look back in time, looks a little like one where a speedboat might have been more effective. And so if I look at the 1960s, mid-1960s to the early 1980s, we see a period where the S&P 500 had lots of up and down swings and only annualized at a little better than 1% for the better part of 2 decades, while inflation was raging closer to 8% a year. Obviously, not a great result in real terms or even nominal terms for your investor who may have been invested fully in the marketplace over that period. Now, why would one make such a claim? Well, if one were to look at the data and get the emotions out of it, the situation that we might be in today becomes quite apparent, we would argue. Now, within this triple threat scenario, the underpinnings of the market has materially changed in recent months, we'd argue, and it looks like most have not noticed. So what do we mean? Well, let's look at it through the lens of how the markets have performed over the last, let's say, 12 months. And if you, of course, see T-bills here at 4 1/3, the S&P emerging markets are up in the mid double digits. But look at the performance of elements in the periodic table with gold, silver, platinum, uranium, up substantially higher than the overall broad market. And even digital assets, ones that have contrived scarcity, are doing much better than the broad markets. If we were to look at now the flow data by the individual investors, we see this trend of fighting the last war continue, with $109 billion going into S&P 500 type index funds. And even though the gold mining index is up by nearly 90% over the last 12 months, individual investors have actually withdrawn funds from that area. If we were to expand the lens out to 5 years, you'll see something quite similar. $1 trillion have moved into S&P type index funds in the past 5 years. And emerging market funds, precious metal funds, natural resource funds have actually had to endure net outflows over this period, even though the relative performance of these sectors has markedly improved in recent quarters. So if we were to look at valuations, as I mentioned before, we're looking at trends now for the S&P 500. Quite interesting. So if one were to try to determine what inning of the baseball game we may be in, especially as it relates to the popularity of large cap US stocks, let's look at this through a 100-year-ish time frame. And what I have here is a nearly 17-year annualized return of the S&P going way back to the late 1920s. And you can see that we have these ebb and flows. This is the cyclical nature of the universal pattern of wave theory. And so we have periods where the S&P has done very well. As we see here in the early 1960s, the S&P annualized for over 12.5% for the previous 17 years. Here, however, in early 1980s, we have the S&P that annualized at less than 1% for the previous 17 years. Of course, here in the late 90s, we had a great period. In the 2016 time period, we had the S&P that earned less than 2% a year for extended period of time. And here we go. We're up here at 1475. Really, if I were to break this down into percentiles, we're in the 99.5-ish percentile. This is essentially as good it has gotten for the better part of a century. So it's nice to know where we are from that standpoint. Now, if we were to overlay valuations, how much are we paying for the stocks we're buying? Well, Warren Buffett has this famous indicator, very simple. It's the size of the stock market by capitalization divided by the size of the economy. So we have the market capitalization to GDP ratio. And when this ratio is above 100, it's saying, hey, things are getting kind of pricey. Well, we got to 143% in March of 2000, pretty much at the high for maybe a decade and a half. And then we have today, we are 216% capitalization to GDP. So this is historically unprecedented over the last 3/4 of a century. So if we were to look at something very simple as price of sales, how much are we paying for $1 of top line sales of a company? We're now over 3 1/3, which really on a closing basis on a monthly side is really unprecedented, also going back spanning nearly a century. The CAPE ratio, a normalized price earnings ratio, is at nearly 40. And so as we put these together, we can see that we're really kind of frothy here, especially as relates to the capitalization of the large companies, and nothing better to show the concentration levels to show how big large companies have gotten vis-a-vis their counterparts in the mid-cap and small-cap side. We have the top 10% of companies inside the various market exchanges in the United States running at 86%, meaning that the bottom 90% of stocks only account for less than 14% of the entire capitalization of the stock market. This is quite extreme, and if we see other periods where this ratio had topped, albeit at much lower levels than today, those were multi-decade tops for the U.S. stock market. So, and of course, how can I not talk about valuation and long-term trends without also bringing up the sentiment of the individual investor. Here, this is from the St. Louis Federal Reserve. We're looking at the percentage allocation to equities as a percentage of total financial assets for individual households and nonprofit organizations. And again, we see something very similar that resembles these trends, and that is people tend to love the markets at material highs. They hate the markets at lows like they did in early 1980s. And here we have 45%, or a record over the past near century, of investment assets as a percentage of households. And that is a problem because usually when people are all in, the marginal buyer is just not there to the extent they might have been before earlier in the cycle. And it becomes very difficult for this cycle to basically continue. And so if I were to just break this down to a simple table, we're basically near 100 percentile as it relates to long-term trends, valuations, and the all-in nature of the investing public as it relates to U.S. stocks, and especially mega cap and large cap U.S. stocks. Now, can these data points be indicative of what to expect in the future? We would argue yes. However, there's a caveat. So let's tackle the yes part first. Going back to this CAPE ratio, we're nearly 40. And if we were to plot the forward 10-year returns of the S&P based on these data points, we get a very interesting correlation. And that is, the higher the CAPE ratio is, the lower the returns of the S&P are for the next 10 years. So here we have a CAPE ratio of 40, and every time in the past century the CAPE ratio has been at that level, the future returns of the S&P have been negative. Conversely, when the CAPE ratio is in the single digits, we're looking at very strong returns. These are price returns, not including dividends, for the S&P 500. Now, if we look at sentiment, we see something very similar, and that is when investors are all in, like they were in 68 and 2000 and also today, we would have expectations of very different returns than when the investors were very, let's say, underinvested in equities, like they were in 1982 and also in February of 2009. And so it's quite interesting where people love to buy high and sell low. This is basically a law of the universe. In mass, people basically look at past experience and extrapolate in a straight line going forward. And this is how they make those decisions at the wrong times, essentially. And so if we were to look at the same correlation, and that is the lower amount of investment investors have in equities, we see higher returns going forward for the next 10 years. As investors basically have increased their allocation to higher amounts, the future returns of the S&P actually drop markedly, actually go negative when investors have the highest amount of allocation in equities. This is quite alarming if you put these together, and I would argue when someone comes to you with relatively rosy capital market assumptions, I would really be curious to wonder what those assumptions were, let's say, 15 years ago, and how have they changed since. Now let's tackle the but part. And it comes down to this idea of overt and relentless monetary accommodation. If the rules to the game are changed, then the results of the game would also change. And it starts with the denominator, money. And that's one area, with the United States being the reserve currency for basically 80 years now. That's something that's arguably underappreciated to a large extent, we would contend. So here's base money. If you look at the level of debt, securities, and loans outstanding in the United States, and you can see here from 45 to 71, 25 to 26 years, it's growing at a 4.5% rate. And since 1971, it really picks up steam and now is growing at almost a 9% rate, to the tune of $62 trillion today. This is from the St. Louis Federal Reserve. And about this time, 71, we see a marked increase in the price of homes, growing at less than 1% a year for the better part of 70 years, and now growing at over 5% a year. A $10,000 house in 1900 was only $25,000 in 71, which is now 400,000 plus today. The price of a college education at a Ivy League university has changed markedly. It was 8,000 for 4 years at Tufts in 1971, and now it's 360,000 plus. I'm not sure if that includes books. And look at even the price of soup, or basically everything else in a grocery store, has markedly increased in price since 1971. So what's so special about 1971? What happened in 1971? Well, we would argue a game-changing event occurred. The rules to the game changed in a marked way, and it has changed life for everyone on the earth, arguably. And that is on August 15th of 1971, President Nixon, in quotes, temporarily closed convertibility of gold. And that brings us to the main topic of today's podcast episode, and that is, how do we prepare for the potential of a right-tailed outcome in the financial markets? Okay, Raj, what are you talking about, right tail? If we were to look at relational measurements, we could kind of see in real time what could be happening. And if we use probabilities to our advantage, we have an idea of what the likely scenario in the future may be. So let's go back to this numerator denominator issue that I've been talking about. And that is, we're all conditioned to look at numerators. Hey, what's the price of a nice car? What's the price of a new laptop? We're always looking here. We're never looking at the denominator because we just basically just think it's a stable ratio, the stable denominator. Yes. And so if I look at the S&P 500, let's say we quote the S&P on TV or on the print, or you look at it on your phone or computer, you're looking at the S&P quoted basically over a ratio of 1. Here's the S&P over 1. Now, if I take that 1 out and I put a different asset class as the denominator, let's put gold in there, for instance, okay? We're going to see something that looks very different. And so what if the currency erosion of the US dollar and other currencies around the world, what if they are the prime culprit for the extreme conditions we see today? Remember, history rhymes. Sam Clemens said it a little differently. But things that happened before, especially the human behavior response to inputs, those are highly predictable, especially if you look at it en masse or look to see what rulers will do, understanding Machiavelli's principle. So let's quantify this. We like to use normal distributions and probabilities derived from examining investment returns and the standard deviation returns to get a sense of what type of risk we're undertaking for our clients. Well, what do I mean? Well, here's a normal bell curve. I'm sure we all learned about that in high school. And understand that when you take a wide swath of returns or any type of population, we'll see something emerge that looks quite symmetric with most of the variables in the middle, and then you get these tails, right? And so if I look at the tails, I'm looking at a left tail here on this graph and a right tail. And what's a left tail? Left tail, if I look at from an investment returns perspective, is basically a big downdraft in your portfolio, a big downdraft in returns of an overall market or some type of investment philosophy or investment returns. And so that's something that we've all been conditioned to avoid, with the understanding that the farther down you go, it becomes exponential in terms of how much money you have to make to get back just to even. If I had an investment that went down 10%, I have to go up 10.9%, I'm back to even. If I have an investment that goes down 50%, I have to double my money just to get back to even. And of course, if you go down 75%, you have to go up nearly 3 times to get back to even. A 300% return could take years, if not decades. And that becomes a major problem. This is why a lot of people always try to maintain and stay away from left tail risk. The right tail is something that people in the United States have never even thought about, generally speaking. And that is something we're going to explore. Let's go back to left tail for a second. So if I look at normal distributions of the S&P 500 returns, these are annual returns rolling for 100 years almost. Looking at 25,000 data points, you see something that looks quite symmetrical. And this is the area that we want to avoid. So if I look at this distribution returns here, and I look at the spread of these return streams, now I can calculate with a pretty high confidence level, let's say 95% or 2 standard deviations from the mean, what is a likely 12-month return for the S&P given the historical past. So if I calculate this, I'm getting something like a plus 42 to minus 29, which sounds about right if you look at annual returns of the S&P going back the last 50 years. Sometimes you see returns on outside of that, and those are more tail risk type returns. Now, if I go back to the early 1930s, now we're looking at maybe the most extreme example of a left tail outcome in the United States, where the Dow Jones lost nearly 90%. And that period, that 3-year period, probably shaped the mindset more than one, maybe two, maybe even 3 generations as it relates to the idea of safety, the idea of what's conservative as it relates to investment philosophy, investment returns, investment strategies. And that is, over that little 3-year period, money under the mattress, money buried under the ground, or money basically stored in the freezer in tinfoil was your best investment. If you put money under the mattress in 1929 and took it out to buy stocks or buy companies or buy houses in 1932, 1933, you could have bought almost 8 times as much stock. You could have bought twice the house. You could have bought businesses for pennies on the dollar. That was your best investment. And that probably shaped, the mindset of generations. This is also, if you had debt was really tough because your debt became more valuable if you had a loan against some assets. Of course, you had a capital call if your assets went down. But if you had unsecured debt, the debt became more valuable because the dollar became more valuable. Therefore, it was very, very tough for people who had debt during this period. Now, I would argue the period we are in today is essentially the opposite. We'll get into that in a minute. So here is the distribution returns of the S&P. Now let's look at the right tail. Okay. Raj, the right tail means I'm going to make 50, 60, 70%. I'm all in. And I'm like, okay, that sounds great, but let's find out what are the implications. So what does that come with? What's the baggage that comes with a 50, 60, 70% upside move? Well, obviously there's 2 main risks for right tail. Number one is very simple. If you're not invested appropriately and a right tail outcome occurs for the broad markets, and let's say you're in 70% in municipal bonds, or maybe you're 60% cash and you have a very little equity position, you're going to miss out just on the nominal return on the upside. That's number one risk. Number 2 risk, though, and this is something that I think is just not taught. I would believe a lot of advisors in our side of the business are not even talking about this, or maybe they may not be aware or fully appreciative as it relates to historical precedents. And that is volatility. Think of a motorcycle weaving through traffic in a busy highway. Yes, that motorcycle is going at a high rate of speed. It's getting higher returns, but it's also taking undue risk. And that is the problem that usually, essentially, invariably comes with right tail outcomes. You get a unbelievable amount of volatility, especially as it relates to the volatility we've experienced here in the United States for the past almost 2 decades. So let's quantify that. Let's look at the best performing stock markets over the last 5 years. So here we go. These are not bastions of real economic growth where GDP per capita is going through the roof. In fact, these stock markets are showing that there is serious trouble with the underlying currency of the host country. So let's focus on Argentina. A lot of things are happening in Argentina lately. We have a new government. We also have a huge setback in the government. By the way, this is new in the last couple of weeks, where Milei's party endured a double-digit loss in a big election in Buenos Aires a couple weeks ago. And so if we look at Argentina here, you have a decline in GDP per capita, even though at a time when the U.S. GDP per capita has increased. Obviously, we could talk about this as well, maybe in a different episode, how that might be a little inflated. And so if I had 3 investors in Argentina, let's go back a dozen years, and investor number 1 puts all their money under the mattress in pesos, how do they do? Well, they lost 99.6% of their purchasing power as it relates to how much gold they can buy. Their $100 is now worth 42 cents. Now, also in Argentina, you had very high rates of inflation. And if you had money in the bank, you collected an average of 37% a year in bank interest over the last dozen years. Well, how did that person do? Well, this is a log chart. They did almost as badly. They lost 93% of purchasing power, or $100 invested in 2013 is now worth a little less than $7 today. If you put all of your money in the Argentine Merval index, which albeit is about 50% energy, as opposed to the US market is 3% energy, so put that aside for now, you actually would have done pretty well. You would have basically almost broken even. The Merval index over this period increased by 67% annualized, which is unbelievable. The problem is you get this level of volatility that very few may be able to endure without just going clinically insane, I would argue. So if I take this out, let's say 30 some odd years for the Merval, and I'm looking at a return spectrum that looks more like this as relates to the distribution of 12-month returns, we see something that looks very different than the US markets. We see a very fat right tail. And with the right tail here, you also get a lot of outsized volatility movements that are, in many cases, a little out of the comfort zone, or maybe way out of the comfort zone for a lot of people, especially if they had all their money, all their investments, trying to protect the inflationary forces in this one investment index. So if I look at the Merval, you have a 30% annualized return for the last 30 some odd years, 34 years. And we'll look at the expectations of a 12-month annual return, and that is plus 121 to minus 61. How many people can handle a minus 61? How about a minus 61 2 or 3 years in succession? Albeit, this is the problem with the right tail outcome. You get periods in time where a right tail can look like a left tail, and the volatility is something that is most likely will be a staple of that type of event. And so if I look at a very benign period, here's the Dow Jones World Index, Global Index. From the 1992 to 97 period, I have a very benign period where you have a 15% maximum drawdown, 13, 12, and a lot of 8s and 7s and even below. In this period, the Merval had huge drawdowns. Even though it made 30% a year the last 34 years, you had a 64% drawdown, you have a 72% drawdown. And if you lose 72%, you have to go up 260 some odd percent just to get back to even. How many people can handle that? And so this is what we believe is a potential scenario for the period forward. Maybe not to this degree, perhaps not to this degree, but something that's going to feel a lot worse than what we've seen as relates to drawdown experiences the past, let's say, 17, 18 years, since 2009. Okay, so here's the S&P 500 going back to the beginning of 2020. Now, what is the market trying to tell us? As you may know, we defer to the quote-unquote wisdom of the financial markets. Obviously, the trick is to try to figure out what the markets could be discounting in real time. So there's two ways to take a look at it from our angle. Number one, here's the nominal chart. We have the S&P. And if I overlay the 88-week moving average, and the average we follow very closely, you'll see it's in an uptrend and the market's above the moving average. Solid bull market. Now, we are a bit extended. And so if I underlay the spread between the price of the market and its trailing 88-week moving average, you'll see we're about 16, 2/3% over that at this point. And it's not as high as it was back in January, and it's actually continuing to rise. So it's actually pretty good. It's not like it was in January, it was deteriorating. So, but we are kind of, spread out there. So this is not as optimal as it was. For instance, if I go back to the 2023 period in November, I'm going to zoom in here. You'll see this period where the S&P had corrected to a confluence of the 88 week and its 176 week, which is double the 88 week moving average, that was a great risk reward ratio from our standpoint, where you don't have to be wrong for long if you're making a decided call to be more bullish. Now, like I said, today we're quite spread. We're 16 2/3 off of the 88 week, and we're 35 percentage points off of the 176 week. So this is where we have to understand the risk reward ratios. What is an opportune time to take on a lot more risk, when you might want to take chips off the table, etc. It really depends on the individual investor from that standpoint. Now, if I were to look at the ratio in terms of if I were to look at the momentum of the spread between the index and its moving average, you'll see it was declining back in January as it was making new highs. And today the S&P is making new highs, and that spread actually is kind of still rising. It might have peaked a couple of days ago, but certainly no decided trend lower as we saw earlier in Q1. So this is an area we're watching very closely from that standpoint. Now, of course, this is the S&P in nominal terms over a 1. If we change the denominator and put a different denominator in this chart, and I mentioned before gold, let's see what it looks like now. Very different. We have a ratio now that topped way back in January of 2022 and now is in a decided bear trend below a falling 88-week moving average. This is quite material. And if I would look at this through the angle of the NASDAQ, we see something very similar. And that is the NASDAQ is also in a declining trend versus gold. So the question is, what is the market trying to tell us from this relational angle? Could it be that the capital markets are going through some type of rotation? Is there a capital rotation event underway where the market's preferences for the types of asset classes to outperform in the future might be changing? That is something we continue to ask every day, and that is what we are looking forward to seeing play out in the coming weeks and months. Of course, from our angle, the big lumbering cruise ships of the investment services industry, using all these cap-weighted asset managers, etc. This is an illustration of showing the modern day cruise ship versus the SS Titanic in relation, which is quite crazy to see. Well, you have almost $60 trillion in third-party asset managers that about 4/5 of the advisors out there have outsourced for the money management. And that's the problem. The problem is this is a behemoth. Can it possibly pivot as quickly as it may need if the environment changes going forward and this rotation event actually does play out? That's why we love a speedboat. So going back to this potential triple threat, we view it as maybe a potential generational opportunity from 3 angles. Number 1, these high equity valuations are really centered in the mega cap US spectrum. If we go outside of the mega cap US stocks, there are a ton of great companies either down the cap ladder or overseas that are actually showing some great relative strength and have great stories behind them. And that is one area that we think we may be able to maneuver if the trends continue in that regard. Secondly, bonds, from our standpoint, are yielding negative after the true rate of inflation, not the official rate of inflation. And they've been, even with that said, bond prices have actually been negative for a better part of the last 5-6 years. Yet, investors continue to flow money to the bond sector. Maybe it's just the old habit, not sure exactly why. The question is, at what point might investors be disillusioned with their investments into bonds and may look elsewhere for income-generating type investments? $7 trillion have moved in to the bond fund area in the last, let's say, 12, 13 years by individual investors, and that money has not been treated well over the past half decade. Will that change? And are there opportunities if that flow changes direction? We think there may be. And then lastly, with regard to the autopilot nature where most of the money invested is, we think having the ability to change lanes in an efficient manner might be very important for the period going forward. So putting those together, we are actually very excited about this marketplace, and we thank you for your time. We're going to continue posting these types of podcasts. We're also going to hone in on maybe more specific areas. I'm going to talk more about how we actually change lanes. What are the mechanics behind the lane changes, especially during periods that might resemble a rush hour. We'll talk about potential outcomes for the US dollar with regard to its 80-year-long reserve currency status. We'll talk about capacity constraints in the baseload energy area and what the implications may be going forward. And also we'll talk about maybe a preparation path for this coming and ongoing artificial intelligence revolution and the related robotics revolution. Boy, the next few years, the world could change quite a bit. And I think thinking about this now and preparing for the future might be a very important step. Once again, thank you very much, and we will be in touch.